Welcome to Richard Suttmeier's 4 on 4, 4 blips on my radar screen presented in 4 minutes or less. Today it's all about Federal Reserve policy and whether or not the gremlins at the FOMC will give the market a trick of no rate cut or a treat of 25 basis points this afternoon. My first blip is citing the reason why the Fed should cut the funds rate to 4.5%. Wall Street wants a rate cut to help cure the plague of the credit crunch, which continues to scare the brokerage industry on Halloween. Main Street wants a rate cut to reduce the pain of mortgage resets, which will continue at the current pace for another year. Without help, look for even more haunted houses next Halloween. The yield on the 2-year Treasury closely correlates to Fed expectations, and that yield is below the 200-week simple moving average at 3.876. This discounts additional rate cuts both today and in the future. My second blip is explaining why the FOMC should stand pat and trick the market by not cutting rates. The FOMC has to be fed up with continued spooky confessionals from Wall Street. The last message the Fed wants to send the world is that they are bailing out the investment banking community. Main Street deserves a scolding too, as speculative juices flowed when the housing bubble was inflated between 2002 and 2005. There are other reasons not to lower rates. Gold is approaching $800 the ounce, crude oil above $90 a barrel, continued dollar weakness. If third quarter GDP is reported as expected at 3% this morning, rate cuts should be on hold given unemployment stable at 4.7%. My third blip is showing the bear markets for housing and financials. I view cuts by the Fed as an attempt to prevent recession in the overall economy in 2008-2009. The Philly Residential Housing Index, HGX, is down 32% year-to-date. The home builders cannot complete funded homes given tighter credit standards, and home prices need to slide more to make homes more affordable. This is putting extreme pressures on community and regional banks. The Philly Banking Index, BKX, is down 12.6% year-to-date, and most of the 24 regional banks in the index are writing down bad loans and increasing loan loss provisions. Continued negative balance sheet issues are likely to persist for at least another year. My fourth blip is hearing the cries from the bulls and bears with regard to the cliches. The bulls chant, "Don't fight the Fed," while the bears reply, "Wait for the Fed and up in the red." The Dow should begin a trend towards my annual supports at 13,036 and 12,483 as strength fails within the realm of semi-annual, quarterly, and weekly resistances at 13,925, 14,025, and 14,101. The upside on the S&P 500 should be limited to quarterly and weekly resistances at 1559 and 1566 spot 2. The NASDAQ should trend towards my quarterly support at 2697 as strength should fail versus weekly and semi-annual resistances at 2839 and 2884. That's today's 4 and 4. Join me tomorrow as I prepare for Traders Club on Right Side Live at 6 p.m. on Thursday. Send comments or questions to support at rightsideadvisors.com and include stock symbols.